Hello and welcome back to Audiobook 101, the place where strong book summaries come to life. Here, we don't just listen, we learn, we grow, and we use those lessons in real life. Are you just starting out in the world of investing? Do words like stocks, bonds, and mutual funds make you feel lost or stressed? If so, you're not alone, and you're in the right place. This summary has been made just for beginners who want to understand how investing really works without the hard words and slowness. Whether you've never invested any money or you're just starting out, this guide will give you the tools you need to build a safe financial future. The authors of this book, true experts in long-term, low-cost investing, will show you how to save wisely, invest with confidence, and create a life of lasting wealth. So, if you're ready to take your first step toward financial freedom, let's dive into the Bogleheads Guide to Investing. Before we start the first part, I have a small request. If this summary helps you, please like it, leave a comment, and subscribe to the channel. If you know someone who could use this, share it with them. It could change how they handle money. Pick a good way to handle your money. Imagine this. If you took 100 Americans at age 25 and watched them until they were 65, stats show that when they retire, only one would be very rich. Only 4 would not need money from others. The other 95 would still have problems, some needing help from the government, others from family, and many just not able to stop working. Think about that. The United States is a very rich country, but only 5 of its people can live without money problems. Why is that? To know why, we need to ask, how are you handling your money? Are you someone who borrows, spends, or saves? Let's begin with borrowers. These are people who don't think much about the future. They live for today. Take Bill and Betty, for instance. They drive fancy cars, wear pricey jewelry, and live in a big house. They seem successful at first glance. But behind the scenes, their whole way of life is based on borrowed money. Credit cards, loans, monthly payments, it's all debt. They aren't building wealth. Instead, they're getting into financial trouble, building up what we could call negative wealth. If they lost their jobs or had a sudden problem, their whole way of life would fall apart. The cars would go. The house might be taken back by the bank, and their things might be sold off. Friends and neighbors might think they're doing great, but the truth is, it was all based on credit. Borrowers enjoy life now by risking their future. Now, let's talk about the second group, the consumers. James and Kathy are a normal example. They buy things they can afford, like a phone, a car, or a trip. They make sure it matches their pay. They don't live in luxury, and they don't borrow much money. They also try to save, but costs are often so high that there's not much left to save. Their life is better than those who borrow. But here's the problem. They haven't planned for the future. They're not working toward being financially free. They're just getting by. Then there's the third group, the savers. People like Ken and Kim. They think differently. Their pay might be the same or even less than those who borrow or spend, but they always seem to have more money. Why? Because they have a simple, strong habit. They save at least 10 of their pay and invest it. These are the people who slowly build real wealth. They might retire early, live without stress, and never worry about bills again. Keepers don't act without thinking. They plan what they do. They don't just make money, they make it grow. So think about how you live now. And more importantly, how do you want to live? If this made you see how important investing is, you're already doing well. But before you start investing, there are 3 simple things you need to know. First, start thinking about your total worth, not just your paycheck. There's a difference between what you earn and what you own. What you earn is your income. What you own is your wealth. Even if you earn $1 million in a year, if you spend it all, you have nothing extra. Saving isn't about making more money. It's about keeping more of the money you already have. Second, get rid of debt with high interest rates. Before you invest any money, pay off loans or credit cards that charge high interest. Why? Because you won't find an investment that gives you a sure return as high as the interest you pay on debt. Think about it like this. Paying off debt is like getting your money back without risk or taxes. Also, have some savings for emergencies. Life can be hard to guess. You might get sick, crash your car, or lose your job. You need money ready for these times. And keep going. Get the right insurance to keep yourself safe. This way you're not just getting ready to grow. You're keeping safe what you already have. Start young and put money in often. In 2005, John Bogle, who started Vanguard, met with some fans in Florida. At dinner, Mr. Bogle read a cool letter he got from someone who owned Vanguard stock. This person had been putting money in since the 1970s and now had over 1.25 million. But here's the crazy thing. This person never made more than $25,000 a year. Stop and think about that. How does someone who doesn't make much money become a millionaire? Did he steal from a bank? Did he win the lottery? Did he get rich quick by chance? None of that. The truth is much simpler and stronger. He just invested regularly over a long time. This story shows how amazing compound interest is, which Albert Einstein thought was the strongest thing in the world. Many people who don't make a lot of money each year think the only way to get rich is to win the lottery. But winning the lottery is less likely than getting hit by lightning. It's a dream, not a plan. Getting rich doesn't need luck. It needs waiting, control, and time. One important idea to know is the rule of 72. This easy formula helps you guess how long it will take for your money to double. Just divide 72 by the yearly return rate. For example, if your investment makes an average of 8 each year, your money will double in 9 years, because 72 divided by 8 is 9. That's the wonder of compounding. Your money not only grows, but the growth itself starts to grow. Over time, the results are huge. And the best part? Anyone can do this. You don't need to be a money expert. You don't need to make a lot of money. You just need to start early, keep going, and spend less than you have. The main rule is simple. Spend less than you make. Save at least 10 of your money, no matter how small it seems. The earlier you start, the bigger the reward. And yes, it might take some work. You may need to buy used instead of new, ride a bike instead of having a car, eat out less often. Every small saving adds up. You could even think about moving to a cheaper city, a cheaper area, or even a country where things cost less. The goal is to lower your costs as much as you can so you can save and invest more. Because in the end, wealth doesn't come from what you make. It comes from what you keep, grow, and protect over time. Know what you're buying. Before you start putting your money into things, it's good to know about the different choices you have, like stocks, bonds, government bonds, groups of investments, and plans for later in life. Each one has its own goal, how risky it is, and how much you could make. The more you know about them, the better you can choose. Let's start with stocks. When a company sells stocks, it's like offering small pieces of the company to people. So when you buy a stock, you own a little bit of that company. After the first time they sell stocks, stocks can be bought and sold easily, usually with the help of a stock person. These people charge money for helping you, and the price of a stock can change depending on what's happening in the market. Next, we have bonds. Buying a bond is like letting a company or the government borrow your money, and they pay you interest for it. Over time, you get regular payments, and in the end, you get your money back. Simply put, bonds give you money through interest. Companies, government groups, or the U.S. Treasury can sell bonds. U.S. Treasury bonds are seen as the safest because the U.S. government fully supports them. Now, let's talk about mutual funds. Imagine a mutual fund as a container holding different stocks, bonds, or other investments. Many people put their money together, and a manager invests it for them. There are two main types of mutual funds, active and index. With indexing, the fund tries to do as well as a standard index, like the S&P 500, which follows the 500 biggest U.S. companies. This is a simple, cheap way that has worked well over time. Active managers, however, choose stocks and bonds they think will do better than the index. While this sounds good, it often means higher costs. Also, most active funds have not done better than the market over time. Lastly, there are annuities. These are like insurance plans that give you a set income for life, usually after you stop working. They offer security and comfort, but they can be hard to understand and have costs you should know about before buying. Now, you don't have to learn all this alone. There are many good websites where you can learn more about these ways to invest. The main thing is to keep learning, be curious, and be sure you know where your money is going before you invest it. Keep your money's worth with bonds that fight inflation. How much do you need to save? Inflation is like a quiet robber. It doesn't break into your home or take your things at night. Instead, it slowly takes away something more important, what your money can buy in the future. Imagine you have 1,000 now. 10 years later, you might still have that 1,000 in your savings. But here's the issue. It won't buy as much as it does now. Prices go up, and your money's worth slowly goes down over time. It's easy to think, I haven't lost anything. My money is still here. But really, you've lost something you can't see, but is very important: what that money can actually buy. Just ask your grandparents what they bought with $1 long ago. You'll probably hear stories that sound unreal today. That's what inflation does, and it never stops. That's why keeping your money's worth is as important as saving and investing. One good way to do this is with bonds that protect against inflation, like US Treasury inflation-protected securities TIPS. These investments change with inflation, helping your money stay worth the same over time. But now, the next big question: how much do you need to save? There's no single right answer. The amount you need depends on a few things. 1. How much you're saving now. 2. How old you are. If you're young, you have more time for your investments to grow. 3. When you plan to stop working. 4. How long you'll need your savings to last. 5. How much prices are expected to rise. Simply put, the sooner you begin, the easier it is. The longer you wait, the more you'll have to save to make up for lost time. Also, don't count on getting money from family to fund your retirement. Your parents might still be healthy and using their own money when you retire. Your retirement should be based on your own savings, not someone else's. Think about all these things: your income, age, goals, and how rising prices will affect you. This will help you figure out how much you really need to save for a safe and independent future. True money freedom means knowing your money will last. Keep investing simple. Use index funds for most or all of your investments. Many people don't know that stockbrokers and fund managers often make money from fees, not from doing better than the market. These fees come from their clients' money. But if you invest on your own, you have a good chance, £70, of doing better than the market over time. This is because you save money by avoiding management costs, commissions, and trading fees. We often learn some common ideas in life. Don't settle. Always want the best. Do what you love. Get advice from experts. If unsure, act quickly in a crisis. History repeats. These might be great rules for life, but they can be bad for investing. If you try to get the best return, you might buy risky stocks. If you follow your feelings, you might make choices based on emotion. If you act fast when the market drops, you might sell in a panic. If you think the past will always repeat, you might miss new things happening. Sometimes good investing means doing the opposite. Be happy with a good enough return, and you'll probably do better than most people. Don't let your feelings control you, and stick to your plan. Don't just listen to experts, especially if they cost a lot of money. Keep going even when the market is rough. Know that you can't be sure what will happen because no one can see the future. This is why index funds are so good, and why many experts say to make them the main part or even all of your investments. With index investing, you don't need to know a lot about money, have special skills, or watch it all the time. You just put money into a fund that copies a part of the market, like the SP 500, and let time and growth do their thing. Index funds have very low costs, no managers making choices, and no need to watch them all the time. You don't have to pay a broker, and you don't have to pay someone to check your investments every day. Just put money in, set it up to happen on its own, and don't worry about it. Over many years, this easy plan has often done better than most funds where managers are actively picking investments. It takes away the guessing in investing and replaces it with slow, regular growth. So if you want a smart, easy, and good way to build wealth, keep it simple and let index funds do the hard work. Deciding how to spread your money is about putting your investments in different types of things to lower risk. It's based on a simple but strong idea. Don't put everything you have in one place. If one thing goes wrong, your whole plan won't fail, because you have other things that are still okay. But how do you really do it? It starts with asking yourself two basic questions. 1. What types of investments should I pick? 2. How much of my money should I put into each one? Trying to answer these questions has led to some important ideas about investing. One of the most famous is called the efficient market theory, or EMT. In the early 1900s, a young French math expert named Louis Bachelier wrote a paper for his PhD that started the idea of EMT. This theory says that it's almost impossible to do better than the market because all the information we know is already factored into stock prices. Simply put, the market is always one step ahead. About 20 years later, A student named Alfred Cowles looked at over 7,500 guesses made by financial companies. He compared these guesses to how the stock market actually did. What did he find? He figured out that these companies couldn't accurately guess how the market would move. In 1973, a Princeton professor named Burton Malquill also came to this idea. He wrote a very famous book called A Random Walk Down Wall Street. It made popular the idea that it's not possible to guess when the market will go up or down. He said that markets are not predictable, so don't try to be smarter than them. If you can't guess the market, what should you do? This leads us to another important idea called the modern portfolio theory, or MPT. It was created by Harry Markowitz, who won a Nobel Prize. MPT says that risk and return are related. It tells you how to balance them to make a good portfolio. Imagine you have two investments that should give you the same amount of money back. Investment A grows slowly without big changes. Investment B goes up and down a lot, but in the end it gives you the same amount of money. Which one would you pick? Most people would pick investment A. This liking for things that don't change much is called risk aversion. It's a key idea in smart investing. Now that we know these ideas, let's think about you. Ask yourself these 4 important questions. 1. What do you want to achieve with your money? 2. How long will you invest for? 3. How much risk can you handle? 4. What is your money situation now? Are you saving for your child's school? Planning for when you stop working? Or trying to buy your first house? What you want to achieve decides not just how much you need to save, but also how your investments should be set up. If you need the money soon, like in 3 years, for school fees, stocks might not be the best choice. The market could go down when you need to take the money out, and you'd have to sell when it's low. It's also important to think about how much risk you can take. Only invest in risky things if you can handle losing money. And of course, your money situation now is very important. For example, someone sure of getting a pension or steady income later might not need to save as much for retirement as someone without a pension or other help. Good asset choices mean finding the right mix of growth and safety, and between what you want long-term and what you need now. When done well, this becomes the key to investing success. Costs are important. Keep them low. Mutual fund taxes. In many things, we think that paying more means getting something better. But this isn't true for mutual funds. In investing, every dollar you pay in fees is a dollar less you could earn. That's why it's important to keep your investment costs as low as you can. Mutual funds usually have 3 kinds of costs. 1. Costs when you buy. 2. Costs later. Costs when you sell. 3. No cost to buy in. Let's look at each one. A cost when you buy is also called a purchase fee or a commission. You pay when you first buy into the fund. This fee lowers the real amount that is used for investing. For example, if you put money into a fund with a 5 front load, only 9,500 will be invested out of every 10,000. The other 500 goes to the person selling you the fund. Now, think about this. A year later, the fund says it made 10. At first, it seems like you made 1,000. But really, you only made 10 on 9,500, which is 950, not 1,000. That's the hidden cost of high fees. Next, there's the fee you pay when you sell, called a back-end load. This fee is charged when you sell your fund shares, mostly if you sell them soon after buying. The longer you keep the investment, the less this fee usually is. If you keep the fund long enough, the fee might go away completely. Lastly, there are no-load funds. These funds don't charge fees when you buy or sell. But they still have some fees, like fees for buying, account fees, fees for switching funds, and most importantly, management fees. These can slowly reduce your earnings, especially if they are more than usual. Now that you know how mutual funds can quietly take money from your investments through different costs, it's easy to see why cheap index funds are a better choice. They don't need a broker, don't charge sales fees, and have very small management fees. In short, costs are very important. But there's one cost that hurts even more than fees: taxes. Let's look at an example. Imagine someone put $1 into a tax-deferred account in 1963. After 30 years, that dollar would become 21.89. Now imagine if that same investment was made in an account where you pay taxes. After 30 years, the value would only be 9.87. That's less than half. Taxes have a big effect over time. So how can you pay less in taxes? Start by not changing your investments too often. Buying and selling funds a lot can mean paying more taxes on profits, especially if you sell them quickly. These short-term gains are often taxed at a higher rate than long-term gains. Instead, keep your investments for a long time. The longer you keep them, the less tax you'll pay, especially when the profits are seen as long-term. Also, when you can, use accounts that are good for taxes, like IRAs or 401ks in the US. Here, your investments can grow without you paying taxes now or even ever. Remember, it's not just about how much you make, but how much you keep. And keeping your costs low and your taxes down is a really good way to grow your money over time. Spreading out your investments, trying to find the best performers, and timing the market can all hurt your wealth. You've probably heard that you shouldn't put all your eggs in one basket. That's good advice for investing too. Putting all your money in one stock or company is like betting everything on one throw of the dice. If that company does badly, you could lose all your money very quickly. A better idea? Spread your money around. Put your money in different things to lower your risk. Sometimes a stock might seem like a great idea. Maybe it's in the news a lot or your friends are excited about it. But no matter how good it looks, don't be too greedy. Spreading your money around is your safety net. And spreading your money around means more than just having different stocks. It also means having bonds, index funds, mutual funds, or even other kinds of things. That way, if one part of your money doesn't do well, the other parts can help make up for it. Another mistake people make is thinking that what did well before will keep doing well. But that's not how the market works. What happened? Barron won. But here's what smart money didn't tell you. Over the next 5 years, Barron's portfolio lagged Markman's by a wide margin. And after that, Barron's overall record was no better than average. The point is, 1 year or even 5-year performance numbers don't tell you much about a fund manager's long-term ability. Anyone can get lucky for a short period. The real test is whether they can consistently deliver good results over many years. Don't fall for the hype. Do your own research and focus on long-term results. Active management versus passive management. Now let's talk about 2 different ways to invest: active management and passive management. Active management. This is where a fund manager tries to beat the market by picking specific stocks or timing the market. They do research, analyze companies, and make decisions about when to buy and sell. The goal is to outperform a specific benchmark like the S&P 500. Passive management. This is a more hands-off approach. Instead of trying to beat the market, the goal is to match the market's performance. Passive funds, like index funds, typically invest in all the stocks in a particular index, like the S&P 500. The idea is that over the long run, it's hard to consistently beat the market, so you're better off just tracking it. The case for passive management. So, which approach is better? While active management sounds appealing, with the potential for higher returns, the evidence suggests that passive management is often the better choice for most investors. Here's why. 1. High costs of active management. Active funds typically charge higher fees than passive funds. These fees can eat into your returns, making it harder to outperform the market. 2. Difficulty in beating the market. Studies have shown that most active fund managers fail to beat their benchmark over the long term. This is because the market is very efficient, and it's hard to consistently find undervalued stocks or time the market correctly. 3. Tax inefficiency. Active funds tend to have higher turnover rates than passive funds. This means they buy and sell stocks more frequently, which can generate more taxable gains. 4. Simplicity and transparency. Passive funds are simple and transparent. You know exactly what you're investing in, and the fees are low and predictable. The importance of asset allocation. No matter whether you choose active or passive management, the most important factor in your investment success is asset allocation. This refers to how you divide your portfolio among different asset classes, such as stocks, bonds, and real estate. Asset allocation is important because different asset classes have different risk and return characteristics. Stocks tend to be riskier than bonds, but they also have the potential for higher returns. By diversifying your portfolio across different asset classes, you can reduce your overall risk and improve your chances of achieving your financial goals. How to determine your asset allocation. Your ideal asset allocation will depend on your individual circumstances, including your age, risk tolerance, and financial goals. Here are some general guidelines. Younger investors. Younger investors typically have a longer time horizon, so they can afford to take on more risk. A portfolio with a higher allocation to stocks may be appropriate. Older investors. Older investors typically have a shorter time horizon, so they may want to reduce their risk. A portfolio with a higher allocation to bonds may be appropriate. Diversification. Don't put all your eggs in one basket. Diversification is another key principle of investing. It means spreading your investments across different assets within each asset class. For example, instead of investing in just one stock, you should invest in a diversified portfolio of stocks, such as an S&P 500 index fund. Diversification helps to reduce your risk because it reduces the impact of any one investment on your overall portfolio. If one of your investments performs poorly, the other investments in your portfolio can help to offset those losses. The importance of rebalancing. Over time, your asset allocation may drift away from your target allocation. This is because some asset classes will perform better than others. To maintain your desired asset allocation, you need to rebalance your portfolio periodically. Rebalancing involves selling some of the assets that have performed well and buying more of the assets that have performed poorly. This helps to keep your portfolio in line with your risk tolerance and financial goals. Dollar cost averaging. Investing over time. Dollar cost averaging is a strategy of investing a fixed amount of money at regular intervals, regardless of the market conditions. For example, you might invest 100 every month, no matter whether the market is up or down. Dollar cost averaging can help to reduce your risk because you're buying more shares when prices are low and fewer shares when prices are high. Over time, this can help you to achieve a lower average cost per share. The importance of staying the course. Investing can be a bumpy ride. There will be times when the market goes up and times when the market goes down. It's important to stay the course and not panic during market downturns. Trying to time the market is a losing game. No one can consistently predict when the market will go up or down. The best thing to do is to stick to your investment plan and focus on the long term. Common investing mistakes to avoid. Here are some common investing mistakes to avoid. 1. Trying to get rich quick. Investing is a long-term game. Don't fall for get-rich-quick schemes or try to time the market. 2. Investing based on emotion. Don't let your emotions guide your investment decisions. Stick to your investment plan and don't panic during market downturns. 3. Not diversifying. Diversify your portfolio across different asset classes and investments. 4. Paying high fees. Be aware of the fees you're paying and choose low-cost investment options. 5. Not rebalancing. Rebalance your portfolio periodically to maintain your desired asset allocation. 6. Ignoring taxes. Be aware of the tax implications of your investment decisions and take steps to minimize your tax liability. 7. Procrastinating. The sooner you start investing, the better. Don't put it off. How to choose a financial advisor. If you're not comfortable managing your own investments, you may want to consider working with a financial advisor. A good financial advisor can help you to develop a financial plan, choose investments, and manage your portfolio. When choosing a financial advisor, it's important to find someone who is qualified, experienced, and trustworthy. Here are some questions to ask a potential financial advisor. What are your qualifications and experience? What is your investment philosophy? How do you get paid? Are you a fiduciary? Can you provide references? The importance of financial literacy. Financial literacy is the ability to understand and apply financial concepts such as budgeting, saving, investing, and debt management. It's important to be financially literate so that you can make informed financial decisions and achieve your financial goals. There are many resources available to help you improve your financial literacy, such as books, websites, and workshops. Take the time to educate yourself about personal finance. Conclusion: investing is an important part of building wealth and achieving financial security. By following the principles outlined in this chapter, you can increase your chances of investment success. Remember to focus on the long term, diversify your portfolio, and stay the course. Real estate investing. Real estate can be a good investment, but it's important to understand the risks and rewards before you get started. Benefits of real estate investing: potential for appreciation. Real estate can appreciate in value over time, providing you with a return on your investment. Rental income. You can generate rental income from your real estate investments, providing you with a steady stream of cash flow. Tax benefits. There are a number of tax benefits associated with real estate investing, such as depreciation and mortgage interest deductions. Inflation. Hedge. Real estate can be a good hedge against inflation, as rents and property values tend to rise with inflation. Risks of real estate investing. Illiquidity. Real estate is not a liquid asset, meaning it can be difficult to sell quickly if you need to access your money. Maintenance and repairs. You're responsible for maintaining and repairing your real estate investments, which can be costly. Vacancy. You may experience periods of vacancy when your property is not rented, which can reduce your rental income. Property taxes and insurance. You're responsible for paying property taxes and insurance, which can be significant expenses. Market fluctuations. Real estate values can fluctuate, and you could lose money on your investment if you sell at the wrong time. Types of real estate investments. Residential real estate. This includes single-family homes, townhouses, condos, and apartments. Commercial real estate. This includes office buildings, retail stores, and industrial properties. Raw land. This is undeveloped land that can be used for residential, commercial, or agricultural purposes. Real estate investment trusts, REITs. These are companies that own and operate income-producing real estate. If you had copied Ron Barron's investments, you would have lost only one. This might sound bad, but the whole market, S&P 500, dropped by 12 that year. So Barron did better than most. But if you had copied Robert Markman's investments, you would have lost a huge 64 of your money. What does this mean? You can't know for sure if one manager will do better than another, or if they just got lucky. And even if they do well for a short time, you don't know what will happen later. Magazines and news shows run these contests to get more readers and viewers, not to help you invest. It might be fun to watch, but it's not smart to risk your money based on news stories or quick guesses. The takeaway? Spread your money around in different investments. Don't chase after the latest popular thing. Ignore short-term excitement and stay with a plan for the long run. Building wealth isn't about getting lucky with big wins. It's about doing things regularly, staying focused, and keeping your money safe. Here are some smart ways to save for college and handle a sudden large sum of money. Let's begin with something everyone knows. The more education you have, the more money you'll probably make in your life. That's why parents everywhere put their money into their kids' schooling. They want their kids to have a better future and better jobs. Numbers show that people with college degrees make more than those with just high school diplomas, and high school grads make more than those who quit school. Education really does pay off. If you want to save for college, there are some good ways to invest. One easy way is to save money in the parent's name. This way, the parents decide how and when to use the money, and anyone can put money into the account, no matter how much they earn. Another choice is a custodial account. People often use these to keep birthday money, gift money, or savings for a child's future. The money is legally the child's, but a parent or guardian takes care of it until the child becomes an adult. Each way of saving has good and bad points. What works for one person might not work for another. So, it's smart to read a few books or talk to an expert to find the best plan for you. Now imagine you suddenly get a lot of money. Maybe you won the lottery, got an inheritance, settled a divorce, received an insurance payment, or sold a business. This kind of surprise money is called a windfall. Windfalls can feel great, but they can also bring strong feelings like happiness, worry, confusion, or even guilt. Someone who wins the lottery might be very happy at first, but also feel stressed or like they don't deserve it. Someone who sells their business might feel proud, but then feel lost without a purpose. After a divorce settlement, some people feel hopeful, while others feel sad or confused. The feelings are real, but so is the chance of messing up the money. That's why it's important to handle a big gain carefully. Here are 4 easy steps to follow. 1. Put the money in a safe place and don't use it for at least 6 months. 2. Figure out what the money can really buy, not just what it looks like on paper. 3. Make a list of what you really want to do with the money and your life. 4. Get help from a professional, like a certified financial planner or CPA. But why wait 6 months? because during that time, your feelings might affect your decisions. Choices made when you're very happy or sad are usually not smart. Most strong feelings like excitement or sadness usually get better in about 6 months. Also, a lot of money can seem like it will last forever, even if it's not enough for your whole life. That's why it's good to figure out what your big gain can and can't pay for. Once you've done that, think about what you want your future to look like. Do you want a different job? Leave your current one. Live in a new city or country. Your list of wants should show what's really important to you, not just what seems impressive. And, until you know enough about money to handle it yourself, get help from someone you trust. A certified accountant or financial advisor can help you use your new money wisely, keeping it safe from bad choices, extra taxes, or decisions based on feelings. Because when used well, a windfall is more than just money. It's a chance to change your life. Do you need someone to help you? Keep track of how you're doing and make changes when needed. A long time ago, a broker joked with his friends about something people often said at his work. When someone buys or sells something they invest in, the broker makes money, the company makes money, and 2 out of 3 isn't bad. It might sound funny, but it shows something important. A brokerage firm's main goal is not to help you get rich, but to make money for themselves. How do they do this? By getting clients to buy and sell often, which means more commissions for the firm. So you should ask yourself, who are they really helping? You or themselves? If you just trust a broker to handle your money, it's like asking a fox to watch over chickens. You might get some advice, but is it really what's best for you? That's why it's often better to be a DIY investor, someone who makes their own money decisions. Anyone can make a business card that says financial advisor, investment consultant, or wealth planner. But in many places, you don't need special training, certificates, or tests to use those titles. Still, many people trust these so-called experts more than they trust their own judgment. Even if you choose to get help from a professional, remember that you still need to know about investing. This is because no one will care about your money as much as you do. If you are a smart investor, one of the most important things you need to do is to rebalance your investments from time to time. As time passes, the way the market moves can change your investments so they are not in line with your original plan. Maybe stocks have grown faster than bonds, or some areas have not done as well as others. Rebalancing means changing your investments to bring them back to your original plan. This not only helps you manage risk, but it also helps you to sell when prices are high and buy when prices are low, which is one of the smartest things you can do as an investor. You don't have to do this by yourself. There are easy tools and programs like Quicken or MS Money that can help you keep track of your investments and rebalance when you need to. The most important thing is to stay involved, stay informed, and stay focused. In the end, your success won't come from quick tricks or perfect timing. It will come from making good choices, avoiding extra costs, and sticking to your long-term plan. Ignore the distraction. To be good at investing, you need to control your feelings and make sure your money lasts. In 1980, not many Americans invested in the stock market, but now more than half of Americans own stocks. This growing group of investors has created a lot of interest, and with that, the investment media industry is doing great. We are always hearing forecasts, expert guesses, and bold advice on TV shows, podcasts, blogs, and in newspapers. Some of this can teach you things, but a lot of it is just noise. Many of these forecasts are just ways to sell you something, using fancy words. And even books, yes, even the ones that sell the most, can be wrong sometimes. Just because a book sells a lot doesn't mean it's true or gives good money advice. Publishers want to sell books, not protect your money. So the best thing to do is simple. Don't let other people tell you what to do with your money. Follow your own plan. Believe in long-term investing. And most importantly, control your feelings. Once you have a good portfolio, you have a new problem. How do you make your money last as long as you live? The answer depends on a few things. How long will you live? What's your portfolio worth now? What if you have big health costs? What if your pension or insurance changes? To understand this, use a good online money planning tool. These tools can guess how much money you can take out each year. This way, you can live well and not worry about running out of money. And remember this, don't waste things, but don't be too cheap either. Lots of people worry so much about running out of money that they don't let themselves enjoy simple things, even when they have enough money. They're always scared, saving every little bit, and never letting themselves have fun with the money they worked so hard to get. Think about Jacob Lader. Even though he had millions of dollars, he drove a really old, bad car, lived in a small house, and didn't even have cable TV. He didn't have any kids, didn't go out much, and often just hung out at his girlfriend's place. He'd call his stock person using her phone and only ate at the cheapest places, if he ate out at all. When Jacob passed away in 1997, it turned out he had a huge $36 million. Even his girlfriend was shocked. She didn't know he had so much money. Jacob's story shows us something important. Money isn't just for keeping safe. It's also for enjoying. So, while planning and getting ready for the future is key, remember to have fun now. The point of investing isn't just to be rich when you die, but to live a good life. Keep your things safe by having good insurance. You can pass things on when you're gone. Life can change quickly. Accidents happen. People lose jobs. Marriages end. Health problems come up. Money problems hit when you least expect it. That's why being ready isn't just smart, it's a must. No matter how well you save or invest, one surprise can mess everything up. That's why insurance is not extra. It's there to catch you if you fall. Here are 5 types of insurance everyone should think about. 1. Life insurance. 2. Health insurance. 3. Disability insurance. 4. Property insurance. 5. Long-term care insurance, especially for older parents or family. Many people forget these must-haves. They buy extra plans for their cars or TVs, but forget about health or life coverage. It's funny how we often protect things we could easily buy again, but forget to protect the things we really can't afford to lose. So, here's a simple rule. Only get insurance for things that would be a disaster if you lost them. For example, life insurance is there to help your family if you die. But if nobody relies on you for money, you might not need it. Pick what's really important to you. Don't make the mistake of spending too much on insurance for the wrong things. Now let's talk about your journey as someone who invests. Maybe you're just beginning. Maybe you've messed up a few times. That's all right. Every investor who's done well has made mistakes when they were starting out. The important thing is that you're learning and getting better. By now, you've learned how to live a good financial life, save money regularly, and start investing early. Learn the basics of stocks, bonds, and index funds. Keep your costs and taxes down. Have a mix of different investments, and don't let your emotions control you. Protect your money with the right insurance. And plan for a future where your money lasts as long as you do. So here's what you should do next. Make a plan and follow it closely. Build your investments with cheap mutual funds or simple index funds. Use the many tools online to watch how you're doing and make changes when you need to. Don't follow trends. Don't let fear or wanting more control what you do. And most importantly, believe in yourself. You don't need a degree in finance to build wealth. You don't need to be perfect. You just need to keep at it, be patient, and stay focused. Getting to financial freedom isn't always quick. But if you stay on track, keep learning, and stay dedicated, you will make it. So go ahead, start now. This is your journey. This is your life. And you can do it. Thank you for listening to this summary of the Bogleheads Guide to Investing. We hope it gave you a clear understanding, confidence, and the drive to take control of your financial future, one smart choice at a time. If you like this, please click the like button, share your ideas in the comments, and subscribe to Audiobook 101 for more summaries of books that can change your life. If you know someone who is new to managing their money, share this with them. It might be the help they need. Until next time, keep learning, keep getting better, and remember, your wealth starts with what you do today. Chapter 1. The Psychology of Money. Key insight. Managing money well isn't just about what you know. It's about how you behave. And behavior is hard to teach, even to really smart people. 1.1 No one's crazy. Each person has unique experiences with money, shaping their financial decisions. For example, someone who grew up during high inflation might avoid debt more than someone who experienced stable prices. Example, imagine 2 investors born in different decades. One saw the stock market crash in their youth, while the other enjoyed years of steady growth. Their views on risk would be vastly different. 1.2 Luck. Risk. Success isn't always about skill, and failure isn't always about mistakes. Luck and risk play big roles in financial outcomes. It's important to remember this when judging your own and others' financial success. Analogy: think of a poker game. A skilled player can still lose a hand due to a bad draw, and a less skilled player can win with a lucky hand. 1.3. Never enough. Many people, even those who are already wealthy, can't stop wanting more. This can lead to taking excessive risks, which can wipe out their gains. Knowing when you have enough is key to long-term financial success. Case study: Rajat Gupta, a successful businessman, went to prison for insider trading because he wanted even more money, despite already being rich. 1.4. Confounding. Compounding is when your money makes money, and that money makes even more money. It's like a snowball rolling down a hill, getting bigger and bigger. The longer your money compounds, the more powerful it becomes. Historical context: Warren Buffett's wealth isn't solely due to his investing skills, but also to the fact that he started investing early and let his money compound for decades. 1.5. Getting wealthy versus staying wealthy. Getting rich and staying rich require different skills. Getting rich often involves taking risks and being optimistic. Staying rich requires humility and being fearful that what you've made can be taken away just as fast. Strategy: saving money is crucial for staying wealthy. It creates a buffer against unexpected events and allows you to seize opportunities when they arise. 1.6. Tails. You win. You don't need to be right all the time to make a lot of money. A few big wins can make up for many small losses. It's more important to focus on avoiding catastrophic mistakes than trying to be perfect. Investment philosophy. Many successful investors focus on finding a few great opportunities and holding them for a long time, rather than constantly trading. 1.7. Freedom. The highest form of wealth is being able to do what you want, when you want, with whom you want. Money can buy you freedom from having to work at a job you hate, or from having to worry about paying the bills. Personal finance. Goal: focus on building wealth to gain more control over your time and your life. 1.8. Man in the car. Paradox. We often think that buying expensive things will make us look good to others, but that's usually not the case. People are more likely to admire your possessions than they are to admire you. True happiness comes from within, not from external validation. Social observation. A fancy car might get you noticed, but it won't necessarily make people like you more as a person. 1.9. Wealth is what you don't see. Wealth is often invisible. It's the money you haven't spent, the purchases you didn't make. We tend to judge wealth by what we see, the big house, the fancy car, but that's often just a small part of the picture. Financial discipline, building wealth, requires discipline and the ability to delay gratification. 1.10. Save money. Saving money is essential for building wealth. It's the gap between your ego and your income. The more you can save, the more options you have in life. Practical tip: automate your savings so that a portion of your income is automatically transferred to your savings account each month. 1.11. Reasonable rational. When it comes to money, being reasonable is more important than being perfectly rational. Trying to make the absolute best decision every time can be exhausting and counterproductive. Just aim for a good enough decision that you can stick with. Behavioral economics. People are not always rational when it comes to money. Emotions and biases play a big role in our financial decisions. 1.12. Surprise. The world is full of surprises. Unexpected events can have a big impact on your finances. That's why it's important to have a margin of safety, extra savings to cushion you from the unexpected. Risk management. Build an emergency fund to cover unexpected expenses like medical bills or job loss. 1.13. Room for error. Everyone makes mistakes with money. The key is to give yourself room for error. Don't bet everything on one investment, and don't get discouraged by setbacks. Investment strategy. Diversify your investments to reduce risk. 1.14. You'll change your goals and priorities will change over time. That's why it's important to avoid making irreversible financial decisions, like buying a house that's too expensive or taking on too much debt. Life planning. Regularly review your financial plan and make adjustments as needed. 1.15. Nothing's free. Everything has a price, even if it's not always obvious. Be wary of get-rich-quick schemes and anything that sounds too good to be true. Financial literacy. Educate yourself about personal finance so you can make informed decisions. 1.6. Be careful about taking financial advice from people who have different goals and values than you do. What works for one person may not work for another. Personal values. Align your financial decisions with your values and goals. 1.17. The seduction of pessimism. Pessimism often sounds smarter than optimism, but over the long run, optimism is usually the better bet. The world tends to get better over time, and those who are optimistic are more likely to seize opportunities. Economic history. Despite setbacks, the global economy has generally grown over time. 1.19. When you'll believe anything, when you really want something to be true, you're more likely to believe it, even if it's not supported by evidence. Be careful about letting your desires cloud your judgment. Critical thinking. Be skeptical of information that confirms your biases. 1.9 altogether. Now. The lessons in this chapter are all interconnected. They all point to the importance of understanding your own behavior, managing risk, and staying focused on your long-term goals. Financial success. A combination of knowledge, behavior, and discipline is key to financial success. Chapter 2. The Psychology of Investing. Key insight. Investing is not just about numbers. It's about understanding how people think and behave, especially during times of uncertainty. 2.1. The illusion of control. Investors often overestimate their ability to control investment outcomes. The market is influenced by many factors, most of which are beyond anyone's control. Market dynamics. Stock prices are influenced by a wide range of factors, including economic news, political events, and investor sentiment. 2.2. The narrative fallacy. We tend to create stories to explain past events, even if those stories are not entirely accurate. This can lead to overconfidence in our ability to predict the future. Cognitive bias. The narrative fallacy is a common cognitive bias that can distort our understanding of the world. 2.3. The confirmation bias. We tend to seek out information that confirms our existing beliefs, even if that information is not reliable. This can lead to poor investment decisions. Information overload. Be careful about only reading news and analysis that confirms your investment thesis. 2.4. The hindsight bias. After an event has occurred, we tend to believe that we knew it was going to happen all along. This can lead to overconfidence and a willingness to take on too much risk. Risk assessment. Don't let hindsight bias cloud your judgment when assessing risk. 2.5. The anchoring bias. We tend to rely too heavily on the first piece of information we receive, even if that information is not relevant. This can lead to irrational investment decisions. Negotiation strategy. Be aware of the anchoring bias when negotiating prices. 2.6. The loss aversion bias. We feel the pain of a loss more strongly than we feel the pleasure of an equivalent gain. This can lead to us making irrational decisions to avoid losses. Emotional investing. Don't let your emotions drive your investment decisions. 2.7. The herd mentality. We tend to follow the crowd, even if the crowd is wrong. This can lead to bubbles and crashes in the market. Market.